You hear it everywhere. Build a portfolio that pays you passive income. Let your dividends cover your bills. Retire early with stocks that pay you to own them. Sounds amazing, right? But here's the part no one ever tells you. How much do you actually need to start? It sounds great, but no one ever tells you how much money you actually need to start. Is it $10,000, $50,000, a whole decade of saving before you can even begin? For most people, that gap makes the whole thing feel out of reach. In this video, I'll show you and Josh how dividend investing can actually work for regular people, starting with just $500. We'll explain how dividends work, how to choose stocks that pay you consistently. We'll use a real-world portfolio and project it into the future. In the end, I will show you how a one-time investment of $500 can grow into a $170,000 portfolio that pays $2,000 a month in dividends. Then I'll show you how to double that income to $4,000 a month with just $2 a week in contributions. But before we dive into the mechanics of dividend investing, we need to talk about the problem that makes this strategy so important, why your money today doesn't go as far as it used to. You've probably noticed how your money doesn't stretch the way it used to. Groceries cost more, rent rises every year, even utilities and streaming services keep creeping higher. That's not your imagination, that's inflation, and it slowly chips away at your money's value, little by little, every single year. If we look back, from about 2015 to 2020, inflation was pretty calm, usually around 2% or even lower. But then boom, in 2021 and 2022, it spiked. Prices across the board shot up. Gas, food, housing, everything started to cost more, fast. At one point, inflation hit over 9%, which was the highest it had been in 4 decades. Things have cooled off a bit since then, but even now, in 2025, inflation is still hovering between 2.5% and 3%. And while that might sound small, it adds up fast. Every year, your dollar buys you just a little bit less than it did the year before. Meanwhile, most people's income isn't growing fast enough to keep up. Last year's report shows the average US household made around $83,000, and that only went up by about 1.3% from the year before. Meanwhile, the inflation around the same time was close to 4%. So on paper, sure, it's a raise, but in real life, it doesn't cover the rising costs. Take groceries as an example. If your weekly bill was $150, 3% inflation raises it to about $154.50. That's an increase of $4.50 each week. Multiply by 4 weeks, and you're paying about $18 more every month. Over a full year, that's an extra $230 for the exact same cart of food. Now imagine that same pattern happening with your rent, your gas bill, your internet, your phone. You get the idea. It adds up. This is why adding money to a savings account isn't enough anymore. Even if the number in your account stays the same, its buying power shrinks over time. To stay ahead, your money has to grow faster than inflation. Investing provides that opportunity, and dividend investing in particular offers one of the most straightforward paths for beginners to do it. But the question is, can you really start with just $500? Many people delay investing because they believe they need thousands of dollars before it makes sense. The truth is, you can start with $500, and here's why it works. First, modern brokerages allow you to buy fractional shares. That means you don't have to save until you can afford one full share of a company like Apple or Microsoft. If a stock trades at $300, you can put in $50 and own a slice of it. Your dividends and returns are paid based on the fraction you own. This removes the old barrier of, I can't afford the big names. Second, the real power of investing isn't how large your first deposit is, but how much time you give it to grow. Even a small start compounds over decades. More on that later. Third, consider what $500 represents in everyday life. It's often less than a new phone or a couple of nights out. A phone loses value the moment you buy it. A night out is fun in the moment, but gone the next day. But $500 invested has the chance to grow, generate income, and compound into something far more valuable. This is why waiting for the perfect time is costly. The best advantage you can give yourself isn't more money, it's more time. Starting early, even with a modest amount, makes a massive difference later. So let's understand what dividend investing really is. Let's keep it simple. A dividend is cash that a company pays you just for holding its stock. When you own stock in a company, let's say Coca-Cola, you're not a customer, you're technically a part owner. And if the company makes a profit and decides to share it with shareholders, they send you a little slice of that profit in the form of a cash payment. That's your dividend. You don't need to sell anything. and it doesn't matter what the stock price is doing on that day. As long as you own the stock and it pays dividends, you get paid. That's dividend income. Dividend investing takes this simple idea and builds a strategy around it. Instead of buying stocks only because you hope the price will rise, you focus on companies that consistently pay and increase dividends. That way you're not waiting for some future sale to cash out, you're earning along the way. But a dividend alone is not enough, especially if you're starting with a low amount, like $500. For this, you need a strategy that really makes this whole thing work. It's called DRIP, which stands for Dividend Reinvestment Plan. And this is where your money starts to multiply. Instead of taking your dividends out and spending them, you use them to buy more shares of the same stock. That might sound simple, and it is, but it's a complete game changer. Because each new share you buy earns its own dividends, then those dividends buy even more shares, and so on. It creates this little cycle: buy, earn, reinvest, and repeat. Let's break it down with a simple example. Say you start with $500 in a stock that pays a 5% dividend yield. The stock costs $10 a share, so you begin with 50 shares. After 1 year, that 5% yield gives you $25 in dividends. Instead of withdrawing it, you reinvest it. At $10 a share, that $25 buys you 2.5 more shares, which means you now own 52.5 shares. The next year, your dividends are based on a slightly bigger investment. Now you're earning 5% on $525 instead of just $500. That gets you $26.25 in dividends, which buys another 2.625 shares. You're up to about 55.13 shares. In year 3, same thing. Now you're earning dividends on $551.25. That's $27.56, which grabs you about 2.75 more shares, bringing your total to roughly 57.88 shares. So in just 3 years, your dividend income grew from $25 to $27.56, and your share count increased by almost 8 shares, without you adding a single extra dollar. It's slow at first, like rolling a tiny snowball down a hill, but keep it going, and it starts to build serious momentum. The key here isn't speed, it's consistency. Reinvest every dollar, let time do the heavy lifting, and the results become undeniable. In the end, I'll show you how this strategy can grow $500 into a $170,000 portfolio that pays $2,000 a month in dividends. Then, I'll show you how to double that income to $4,000 a month with just $2 a week in contributions. But to make this work, of course, not every dividend stock is worth owning. The key is knowing how to filter the good from the risky. That's where a simple set of criteria comes in, and that's what I'll show you and Josh next. If you've ever looked at the stock market, you know there are thousands of choices. Some pay dividends, some don't. Some look tempting, but carry risks that beginners often don't see. The first thing to look at is dividend yield. This is the percentage of income a stock pays compared to its price. For example, if a stock trades at $100 and pays $4 in dividends each year, the yield is 4%. That's your starting income. But here's the catch. A yield that looks too high, like 10 or 12%, can be a red flag. It may mean the company is struggling and can't sustain those payments. For most beginners, a steady yield in the 2 to 5% range is a healthy balance. Next is dividend growth, which you need if you're aiming for a DRIP strategy. A company that increases its dividend year after year is signaling financial strength. If a stock raised its dividend from $1 to $2 over 10 years, that's a 100% increase. The best companies treat dividends like a promise, rewarding long-term investors with consistent raises. Then comes share price appreciation. While dividends are income, you also want the stock itself to grow in value. The best dividend stocks don't just pay you, they also increase in price, which means your investment is doing double duty, earning income and building long-term wealth. Another filter is business durability. Ask yourself, is this company doing something people will still need in 10 or 20 years? Utilities, consumer staples, finance, healthcare, these are industries that don't go out of style. Chasing trendy companies might look exciting, but they rarely deliver reliable dividends. Finally, consider resilience during tough times. Look back at a company's history. Did it keep paying dividends during recessions or market crashes? If yes, that is a positive addition. When you combine these factors, yield, growth, price appreciation, durability, and resilience, you get a portfolio that balances stability with growth. Let me show you what that actually looks like in the real world. Here's a simple, beginner-friendly dividend portfolio made up of 5 strong picks, companies that have a track record of paying well, growing steadily, and standing strong over time. The first piece is the Schwab US Dividend Equity ETF with a ticker symbol SCHD. Think of this as a basket of strong dividend-paying US companies all in one place. It currently offers a 3.75% dividend yield, has increased its dividend by 10.77% annually over the last decade, and its share price has appreciated by around 8.62% annually. For beginners, SCHD provides instant diversification and a rock-solid foundation. Next is Morgan Stanley with the ticker symbol MS, one of the world's leading financial firms. Its current dividend yield is 2.5%, but what really stands out is its dividend growth, averaging 22.4% per year over the past decade. On top of that, the stock price has climbed almost 16.98% annually. It's a great example of a company that combines income with serious long-term growth. Then I have the Federal Agricultural Mortgage Corporation with a ticker symbol AGM. This company supports American agriculture by providing financing to farmers and rural communities. It pays a 3.27% dividend yield, has grown dividends by an incredible 25.27% per year for the last 10 years, and its share price has appreciated 17.34% annually. It's a powerful mix of income, growth, and resilience in a sector people rely on. My fourth pick is CubeSmart with a ticker symbol CUBE, C-U-B-E, a self-storage real estate investment trust. Storage is one of those needs that doesn't go away, even in tough times. CubeSmart currently offers a 5.17% dividend yield with 13% annual dividend growth over the last decade and about 4.12% annual price appreciation. It's a dependable income generator with a defensive business model. Lastly, enter Parfums with a ticker symbol IPAR. This one's a global fragrance and beauty company, not a household name, but that's actually what makes it interesting. It delivers strong results with a 3.16% dividend yield, 20.21% annual dividend growth, and around 15.51% yearly share price appreciation. The next step is to calculate your portfolio metrics, starting with dividend yield, so you know the income your whole basket is likely to generate per dollar invested. Think of portfolio yield as a weighted average. Each stock's yield counts in proportion to how much of the portfolio it represents. In our case, we kept it simple and gave each of the 5 holdings an equal slice of the pie, 20% each, so the portfolio yield is just the plain average of their individual yields. Add them up: 3.75% from SCHD, 2.5% from MS, 3.27% from AGM, 5.17% from Cube, and 3.16% from IPAR, which totals 17.85%. Now, divide 17.85% by 5 equals 3.57%. That's your portfolio dividend yield. You can do the same weighted average process for the other 2 metrics as well, dividend growth rate and share price appreciation. Using the same holdings, the portfolio's dividend growth rate comes out to 18.33%, and the portfolio's annual share price appreciation comes out to 12.51%. So now, the big question: what does $500 in this portfolio look like in 10, 20, or 30 years from now? Let's run the numbers. Let's say Josh invests $500 into this portfolio and simply lets it grow. In the first year, his portfolio is projected at about $600, with roughly $20 in dividends. By year 10, the portfolio will be valued at around $2,400, generating about $120 in yearly dividends. By year 20, the projection climbs to nearly $16,000, with annual dividends of about $1,400, more than $100 per month flowing in. By year 30, the portfolio would be valued at approximately $174,000, and the dividends would reach nearly $24,000 per year. That's around $2,000 every month from an investment that started with just $500. This is compounding at work, slow in the beginning, but explosive over time. Now here's the exciting part. That's with a one-time investment. What if you added just a little bit more money on a weekly basis? Let's take that same portfolio and give it a small boost, just $2 a week. Let's run the projection. Say Josh invests the same $500 and adds only $2 every week. Based on this new approach, by the end of year 1, the portfolio is projected at roughly $700, generating about $20 in dividends. By year 10, the balance grows to nearly $4,700, with annual dividends of about $230. By year 20, compounding accelerates. The portfolio is valued at approximately $34,000, and dividends reach around $3,000 per year. And by year 30, the results become dramatic. The balance is projected at $373,000, producing nearly $52,000 in yearly dividends. That's more than $4,300 every single month from starting with just $500 and adding $2 a week. Want to know why building wealth gets easier after $100,000? Click the video on screen to find out.